Hello and welcome to Business Today. I am Siddharth Zarabi and you're watching our special coverage in the run-up to Budget 2026-27. The economic survey has been tabled in Parliament and it contains a lot of nuggets of information and data that gives us some clues into the mind of what Finance Ministry mandarins are thinking in terms of the budget, and that budget coming up this Sunday to be presented by Finance Minister Nirmala Sitharaman, and that in some ways a roadmap for reforms as has already been discussed. And joining me to decode both the hints from the economic survey and what we should be expecting from the upcoming budget, we are joined by a panel of experts. Sajjid Chinoy, MD and Chief India Economist at JP Morgan. Sonal Varma, Managing Director and Chief Economist, India and Asia ex-Japan at Nomura. Anubhuti Sahay, Head of South Asia Economic Research, India at StanChart. And we also are joined by Tanvee Gupta Jain, the Chief India Economist at UBS Securities. Before I go across to my guests, let's take a quick listen into what Prime Minister Narendra Modi had to say earlier today.
देश का ध्यान बजट की तरफ होना बहुत स्वाभाविक है, लेकिन इस सरकार की ये पहचान रही है रिफॉर्म, परफॉर्म एंड ट्रांसफॉर्म। और अब तो हम रिफॉर्म एक्सप्रेस पर चल पड़े हैं, बहुत तेजी से चल पड़े हैं। हमारे हर निर्णय में राष्ट्र की प्रगति ये हमारा लक्ष्य है, लेकिन हमारे सारे निर्णय ह्यूमन सेंट्रिक है। हमारी भूमिका, हमारी योजनाएं ह्यूमन सेंट्रिक है। हम टेक्नोलॉजी के साथ स्पर्धा भी करेंगे, हम टेक्नोलॉजी को आत्मसात भी करेंगे, हम टेक्नोलॉजी के सामर्थ्य को स्वीकार भी करेंगे, लेकिन उसके साथ साथ हम मानव केंद्रीय व्यवस्था को जरा भी कम नहीं आंकेंगे।
Reform, perform and transform. Sajjid Chinoy, is that a clear hint that the reforms express, as Prime Minister Modi describes it, on the back of what happened in 2025, 2026 will see that express pick up pace, Sajjid?
These are really important sentiments, and I think if this is the an indication of what is to come, that's very encouraging. We did see a series of reforms towards the end of 2025. We saw the GST was rationalized, the labor laws finally got codified. We had FDI and insurance pick up. We've got two committees on deregulation, which is a work in progress, and hopefully that's an ongoing effort at deregulating the economy, which, if you remember, was the theme of the economic survey last year. But Siddharth, I just want to emphasize enough that this is very much a work in progress, as the Prime Minister was alluding to. We cannot become complacent. The economy is undergoing a cyclical recovery. There's no doubt about that, because apart from the reforms that 2025 also saw, was a series of cyclical supports. GST cuts, direct tax cuts, rate cuts, regulatory easing, low inflation, low crude prices. And that's driving a cyclical support. But we can't become complacent because we're living in a very hostile global environment. Deglobalization and tariffs are just one element of it. The other, and trade has been weaponized. But the other part, which I think gets less attention, is just the sheer quantum of excess capacity in China, which last year went all around the world and risks hollowing out manufacturing bases in Asia, in Africa, in Latin America. The only way to counter both these challenges is to become more competitive, which means we need to undergo a relentless pace of reforms. There's some hand-wringing about, why we're not attracting enough capital flows.
Right.
Capital flows are a symptom. If reforms can push on demand, can push on private investment, the capital flows will eventually come.
Absolutely. And Sonal, Sajjid spoke about the previous economic survey and the kind of hints it had dropped. From this survey, what are you picking up in terms of the likely direction that will be unveiled in the budget?
Yeah, Siddharth, I think there are actually two, three things that come out and what are important actually from the economic survey. First is sort of the hints specifically on the numbers around the budget. So I think the real GDP growth projection, which is centered around 7%, along with a higher deflator, does suggest that the budget is going to assume a nominal GDP growth that's in the 10 to 10.5% range. There's talk about how fiscal consolidation has happened, which to our mind suggests that the FY26 target of 4.4% is likely to be met. There's emphasis on general government fiscal consolidation, so not just center, but focus more on state. So these are sort of some of the numbers which sort of come out. A second is sort of the broader economic outlook. And I think compared to a year back, this survey surely hints, I would say, more in the cautiously optimistic camp. It talks about how potential growth in India is, centered closer around 7%. There's talk of benign inflation continuing, even as inflation will pick up on a year-over-year basis, and a lot of the growth recovery actually driven by domestic demand. So sort of the Goldilocks environment, over the next 12 months expected to continue. And third, Siddharth, is really sort of moving beyond next year. Ultimately, I think India, from an economic perspective, is in a good place. And really the focus now is on strengthening the growth foundations in the otherwise more hostile global environment that we are in. And the survey, as it should, goes into the different pillars of this growth.
Right.
Whether it's manufacturing driven, agriculture, infrastructure, skilling, so I think we should see a lot of announcements related to these pillars as part of the budget.
Anubhuti, in addition to your headline observations from the economic survey, I just wanted to also pick up on this point in terms of the macroeconomic stability message that pretty much everyone in the government has been talking about, externally as well as within India. What's the key message there really?
I think that's a very, very important reiteration. I think if we look at the current policy measures, both from the government as well as the RBI, and this has been the case for the last 10 years, there is a key focus on macroeconomic stability. And then along with it, simultaneously, there is a lot of focus on reforming or paving the way for better economic growth. Now, when we look at macroeconomic stability, that is primarily defined by a contained twin deficit, that is fiscal and current account deficit, having enough FX reserves because we live in a highly uncertain global environment, having a right amount of leverage, or in case if it is high, deleveraging, which the government has done over the past decade, both in terms of corporate as well as its own balance sheet. And that focus continues in this economic survey. Even if you look at the fiscal deficit projections or the focus of finance minister on reducing debt to GDP on a medium-term basis towards 50 to 51%, despite growth compulsions, I think that is a strong message when it comes to macroeconomic stability. Even from RBI's perspective, because both the government and the RBI work together to ensure that macroeconomic stability remains the cornerstone of our story. RBI has allowed Rupee to be the shock absorber. We have seen a sharp reduction in capital inflows, and that remains a sore point, and visibility is not really great on that part. The pressure has to be released via one form or the other. The timeline is the only thing which the policymakers can choose, and the weakness in Rupee has allowed those pressures to be released on a far more gradual manner rather than just penting it up from a medium-term perspective. So I think the macroeconomic stability message is talking about fiscal deficit consolidation, allowing external pressures to be released via the rupee depreciation, and continued focus on reforms.
That's a good point there. In fact, viewers, rupee depreciation could pave the way for imported inflation is also a clear message in the survey. We'll come back to the theme with Sajjid, but Tanvee, coming to you. Broadly, beyond the economic survey, two questions in addition to the initial comments that you would want to make. One, in your analysis, has the GST cut boom translated into a sustainable one? Is it up to your expectations, or has it proven to be lesser than what you had expected? And the reason I ask you this is that if you go into the budget making priorities, how will it feed into that, Tanvee?
Absolutely. So if I look at the GST collections and we have seen an indirect tax cut, I would say any indirect tax cut actually leads to bouncy in economic activity over the next 2 to 3 quarters. So I would say we have already started seeing a double-digit growth in auto sales, and I think primarily the data that I can track is the auto sales component, where the growth has been very, very strong. We would expect that to keep on unfolding at least till the June quarter. So I think it is still too early. We still have only seen 1 quarter of data. That data is holding up. We need to see how that impact is going to pan out over the next 2 quarters. So that is something that will be very important. Again, from a GST collection point of view for the upcoming budget, we have taken quite a benign growth assumption, because I believe that the gross tax collection this year in FY27 budget is going to get a much top-up support from the excise duty hike on cigarettes that has been announced after the indirect tax change which we saw in the month of September end. We are also building in excise duty hike on gasoline and diesel. That again is going to provide some more revenue support at the time when the GST collections might be tapered overall for the full year FY27 versus FY26.
Tanvee, I'll come back to you on the specific subject of gold and what it means in terms of any potential macro risk. But Sajjid, I want to come to you on the point in the survey regarding rupee depreciation. What is the survey highlighting, and will it possibly inform actions that are going to be taken in the near future?
I think one has to recognize A, what the global context is, and B, the broader point that policy making is all about trade-offs, right? And I think the issue is India's current account deficit at this point in time is not worrying. It's much below a sustainable threshold. The worry is that capital flows have dried up. And there are a variety of reasons for that. It's all happened in tandem: equity flows, debt flows, FDI flows. Now, the question is, how does one respond to that? And I think the first order response has to be to ensure that any policy is sustainable and viable. We forget that we've just finished first year of a 4-year Trump term. So to protect some artificial level of the rupee, we cannot be burning reserves at an unsustainable pace. That has to be the first order recognition here, that those who argue that, we should not let the rupee depreciate have to understand there's a cost to that. It involves drawing down your reserves, and our buffers are large and beyond question, but you need to preserve these buffers for the next 3 years. So I think that's the first point. The two other points to quickly make, Siddharth, is that given the geopolitical context, a gradually non-disruptive depreciation is actually a healthy thing. Let me explain to you why. Some of our biggest competitors are ASEAN countries to the US market. Tariffs on ASEAN, the effective tariffs are around 16%. Our effective tariff imposed by the US is 33%. So our exporters have a 16 or 17 percentage point disadvantage on tariffs. If the rupee were to gradually depreciate 4 or 5% in a year, that reduces the disadvantage for our exporters, helps labor-intensive exporters and jobs at home. B, a lot of businesses will say, not just in India, but in Asia, given this flood of cheap Chinese imports, there's no incentive to undertake more investment in Asia or in India. If we're complaining about cheap Chinese imports, a 4 or 5% depreciation makes those imports more expensive, gives our domestic substitutes a better chance to compete. So there are both tactical and strategic reasons to tolerate some depreciation, most of all because we don't want to burn our reserves in a hurry. One final point I'll say, there's never a good time, in terms of inflation, but if there ever was a time to absorb some imported pressures, it's now, where inflation remains very benign and core inflation correctly measured has been below 3% for the last couple of years.
Sonal, how much more would you, if you were the policy maker, allow the rupee to depreciate further? Because Sajjid makes that very important point, the last point, that our absorptive capacity is perhaps more than it has been in the recent past at the current moment.
Yeah, I think the assessment on the cost benefit analysis of depreciation is quite dynamic. It's not a static analysis. I think some of the arguments in favor of allowing continued rupee depreciation, which made quite a lot of sense 6-9 months back, may be making less of a supportive argument right now. In a sense, we have actually already lost quite a lot of FX reserves despite allowing currency weakness. And I think at the margin, what we are starting to see is depreciation is feeding into depreciation. So what do I mean by that? You have hedging strategy changing. So you have exporters who are not selling dollars in anticipation of further depreciation. You have importers who are rushing to cover their receivables. We are seeing outflows on the debt side in anticipation of depreciation. So yes, I do think it makes sense for currency to be a shock absorber given the US tariffs. But I think a lot of the adjustment process has happened. And we are probably at a point where we need to debate the cost benefit analysis of sustaining this strategy if this is feeding into itself. I think from a more medium-term perspective, like one of the points that the survey makes, which is quite pertinent, is that you gain export competitiveness by improving on quality of your products and being overall competitive. Currency as a strategy to basically integrate into the global value chains, cannot be pursued in the global environment that we are in right now. And if you have to integrate into the global value chains, that means you will be importing a lot of intermediate products. So your imported components actually become a lot more expensive through this currency depreciation strategy. So I think we followed a fairly good strategy so far. I think we are probably reaching a point where the cost benefit analysis needs to be revisited.
That's a very good point that both of our speakers on this question have made, viewers. And Anubhuti, as I come to you, depreciation feeding into depreciation and the fact that we may have reached limits. Anubhuti, do you sense that that a so-called tug of war, and my words, nobody has said it here on the panel, between Kartavya Path, not North Block any longer because the office has shifted, and Mint Street. Is that tug of war going to continue to play out according to you?
Tug of war in terms of rupee depreciation?
Yes. I mean, the outlook on the rupee, both from Delhi and from Mumbai, the difference, the natural difference.
I don't think there is any kind of a tug of war as of now, at least not till now, because if you look at the latest comments which came from Chief Economic Advisor, he has highlighted that if we look at the rupee depreciation and compare it to the peer currencies depreciation since 2023, it is almost similar. So rather than just focusing on how rupee has weakened over the last 12 months, it's important to have a look at how rupee has moved over the last 3 years versus its peers over the past, few years. So I think that's an important point, which kind of shows that both North Block as well as Mint Street are on the same page. Will it change going forward? I think over the past few years, we have seen a significant collaboration, communication between North Block and Mint Street. And if there is enough convincing that the pressures on external sector can be vented gradually via allowing rupee depreciation is there, I don't think we will see much of a challenge there. I would highlight that one can always debate about the pros and cons of around the pace of depreciation, but the point is, even if RBI starts intervening a lot in FX market to define a particular level for rupee today, does it mean that rupee will not depreciate at a faster pace going into the second half? We are living in a highly uncertain environment where geopolitical tensions have just escalated. Remember, last year that was not the case. So I would still argue in favor of allowing rupee to be the shock absorber. An equilibrium point, markets reach an equilibrium point. And I don't think the second order effect by allowing a gradual depreciation will be worse than than a comparison where RBI intervenes, stops rupee at a particular level and then allows for an abrupt depreciation later in the period. So I think it's a very, very fine balancing. RBI has done a great job, and I hope they allow rupee depreciation to continue. And from the perspective of government, I think they're pretty much in line with where RBI is allowing rupee to move.
Absolutely. And viewers, exports can also become more competitive if you reduce internal costs, for example, power, or continue to reduce logistics costs. I think that's also a point. Tanvee, I wonder if you have a comment on the rupee before I get you back on the original question on gold and the macro risks.
Absolutely. And when we are commenting on rupee, I would also touch upon how do we see dollar? Because that is, you are looking at USD INR.
Yes.
Our largely in-house view is that we expect dollar to actually rebound towards the later part of the year on the back of AI-driven productivity gains and potential tax relief. Obviously, we are assuming that the Fed independence remains intact. But coming back on INR, if I look at the data, the RBI intervention has kind of mitigated some weakness in INR. The risk reward continues to remain unattractive.
Right.
If I look at rupee on a real effective exchange rate basis, it is a 10-year low. If I look at RBI, is still in the process of an unwinding of its forward book. So even on a technical basis, it doesn't look like that you are going to get any support for the rupee. Clearly, as other panelists are mentioning, capital flows are still weak, and there is definitely a delay still on the India-US trade deal, or the external uncertainties are still high. So we still expect INR to continue to remain weak in 2026 as well. We are not expecting any chance of a strengthening. Yes, our fair value model for INR indicates that INR should be trading at 88. It is trading at 92, but we are not expecting any appreciation in INR at the moment.
A very quick comment on gold before I get a wrap-up comments.
I think since we are discussing on INR, let me just quickly touch upon even on gold, because India import bulk of the gold requirement. I would say 87% of our India's gold supply is imported.
Right.
And the sensitivity is that every 10% increase in global gold prices will widen India's current account deficit at least by 15 basis points. And we know that gold is up 83% FITD. Even in volume terms, even if the gold demand by Indians, especially in jewelry, is down, overall, we are still seeing that in value terms, the gold imports continue to go up. So I would say it's definitely a tricky situation, because when I look at gold, definitely it is leading to wealth effect, but then we can question, can it buoy household consumption? Indians never sell gold. We can put it and use it as a collateral for a gold loan. But most of the gold is actually historically has been in the income bracket by household of 2 lakh to 10 lakh.
Right.
And they don't use and sell gold for consumption. They largely use that as a, smoothing their spending, financial needs, using that money for business-oriented needs, maybe a rural consumption, including wedding, education, or healthcare.
Okay. Sajjid, very quickly, 30 seconds to all of you as I run out of time. And one big reform announcement that you personally are looking forward to from the finance minister. Sajjid, that question to you at first.
What I'd be looking forward to, what I want to first, congratulate the government is that they've not succumbed to export pessimism the last 6 months. It would have been easy to say after the lack of a deal with the US, let's turn inward. We haven't. In fact, that's motivated us to go on a spree of signing free trade agreements, right? And
the EU was the latest.
Now, what is the reform that's needed to complement that? In my mind, the old adage in economics, an import tariff is the same as an export tax, has never been truer than in a world of global value chains. So what I'd like to see in the budget is a start of a dramatic simplification and rationalization of the customs duty scheme. So we want to lower tariffs, we want to simplify the whole process, we want to correct inverted duty curves, and thereby make it much easier to import to help to re-export. So I think given the focus on FTAs and export-led growth, we need to clean up the customs duties and import regime so as to seamlessly integrate better into global value chains. I'd be looking for a whole big package on customs duties, lower import tariffs, lower non-tariff barriers, including QCAOs. We focused on income taxes in the past. We've done corporate taxes. We now need to do import duties.
Absolutely. Sonal, that very question, the same question to you.
I would be watching actually the signals on fiscal, and I think a clear and very clear signal on fiscal prudence is needed because bond markets are on tenterhooks because of supply concerns. So I think the message that even as we are moving to a debt targeting regime on the center side, the fiscal deficit will be lowered in the coming years, and that it's not just going to be a center-driven consolidation, but state on the debt side will also consolidate. I think if we do send those clear signals, then at least the fiscal-related concerns that are a big overhang on the bond markets, some of that can be taken off the table.
Okay. Anubhuti, what would you be looking forward to?
I won't look for any one particular reform, whether it is about using, import duty reduction to encourage investments rather than use it for protection, or risk sharing, reducing cost of doing business in India. I mean, an infra project run by central government has a cost overrun of 22%. So we need a whole host of reforms, Siddharth. So I won't focus on one. My only ask would be, even if the government decides to pick one area, the speed of delivery is the ask today. We are living in a world which is evolving much faster than what we are realizing. And unless we deliver on the speed of whichever reform we are, putting as a priority, just asking for one reform change really wouldn't help. So speed is the key thing here.
Absolutely. And as Chandrababu Naidu, Chief Minister of Andhra Pradesh, said at a recent event with group at Davos, it's no longer about ease of doing business, it's about speed of doing business. Closing comments, Tanvee, to you, 30 seconds.
So quickly on the reform, one policy narrative I definitely want Finance Minister to touch upon is India relative representation in the global AI landscape. So articulate a very strong AI narrative, step up funding for digital infrastructure, focus on data centers, semis, electronics, R&D. Our R&D spend has not moved the needle in the last 1 decade. So definitely a narrative on new age technology sectors, I think will be very good from an investor point of view.
Viewers, if I were to add to our expert panel here, I think all measures, possible measures that can lead to a return of capital flows in substantial quantities would be what I would just add to the expert voices who have decoded both the economic survey and given us a sense of what the priorities of the union budget will be. We are practically counting down on the clock for Finance Minister Nirmala Sitharaman to stand up once again, a record speech by her in terms of the number of budgets that she will present and how she will take the reforms express and India's economy beyond and sustain this Goldilocks moment. I thank my entire panel for their time with us today, and with that we wrap up our coverage. We'll be back with more. Until then, goodbye.